If you earn over $250,000 in Canada, that puts you in pretty much the highest marginal tax bracket in any province. That means that you're going to be paying up to 53% in taxes. Given that, there are some things that are non-negotiable to do in order for you to properly manage your tax burden. I'm going to walk you through 5 key things that you can do to manage your tax burden that need to be done by December 31st of 2025. And missing out on some of these things could prove really costly. Now, if you're watching this video, you will notice that this is a small channel. And the reason it's a small channel is because we're just getting started. My name's Sam. I'm a certified financial planner. I live in Ontario. And actually, even though I'm new to YouTube, I'm not new to social media. I've amassed about 100,000 followers across all platforms, even the 450 or so on YouTube counts in there. And my work has been featured in almost every major news outlet across the country. I've also been recognized as a rising star in Canadian finance and been finalist for a few awards, including the Canadian Financial Literacy Advocacy Award by regulated individuals like myself, because I am regulated, licensed, and a certified financial planner. And I've also been finalist for Young Advisor of the Year Award in Canada. With that being said, let's dive into this topic today. The first thing you have to be aware of is something we call tax loss harvesting. If you own shares in a public company and are looking to divest those shares, whether they're in a gain position or whether they're in a loss position, you should do so by December 26th of 2025. That way that you can ensure that they settle in 2025. Just mark your calendars for December 26th. That way you're not running into an issue of having them accidentally settle in 2026. Now, this is important because tax loss harvesting is a strategy that many people implement. Now, you may be thinking like, Sam, the market's up 20+% this year. Why would I ever need tax loss harvesting? What positions could possibly be in a negative position? Well, if you're like some people and you might have made a gamble or two this year in the stock market, you might have taken a little bit more risk than maybe you should have. You may actually own some positions that are in a loss. And instead of it being a complete write-off, you can sell that, claim a capital loss, sell a position like maybe company stock that you own to get out of and divest, and then have offsetting capital gains and capital losses. But that has to be done in 2025. Even though there are some carryback provisions with capital losses, if you want to claim it against the current year's capital gains, the capital loss has to first be claimed against the gain in 2025. For example, if you were to accidentally let this sale trigger in 2026, then you would first have to claim the capital loss against any capital gains in 2026. And then you can carry it back to 2025. So if you want to claim capital losses for sure in 2025, then you need to have this sold by December 26th of 2025. Year end, mark your calendar. Now, it's also important to be aware of tax implications of selling your securities. And I'm going to talk specifically for a moment here about RSUs and stock options. If you're a highly compensated employee, you may find yourself with company stock and you may not understand 100% about how these things are actually taxed. So for RSUs, there's 2 kind of taxable events. One is when you get the shares vested, okay? And whatever the market value of the shares are that have vested, that will be taxed as income in the current year. And then whatever you sell them at, if it's more than the market value they were vested at, then that's a capital gain in the current year. So if you don't sell them right away and hold on to them for a while, then not only will you get taxed as income, but you'll also get taxed on capital gains when you do decide to sell. Now, making some RSP contributions can offset some of this tax burden. I talk about that in depth in another video, so make sure you check out the other videos in the channel around RSUs and taxes. Now, stock options are a little bit different. Stock options are taxed on the difference of the amount the security is worth and the amount you purchase it at. The difference there is going to be taxed as employment income, not as a capital gain. Then when you sell the shares, whatever the shares were worth when they vested with you versus what their current market value is, that's the difference that'll be calculated as capital gains. Now you might think, man, these options are great, but that's a lot of tax to pay. And you'd be right. However, there is something called the employee stock option deduction, which allows you to deduct up to 50% of the actual taxable amount, the difference between the market value and the value you purchase the stocks at. You can deduct up to 50% of that so long as you got granted less than $200,000 worth of shares at the time you were granted the shares. Now, I know that's a little bit complicated. It's why it's always important to talk to a financial advisor or planner, talk to a CPA about these things. But it doesn't actually stop there. It gets even a layer more complicated with stock options. If you're liking this video so far, please hit the like button and subscribe if you're not already. If your deduction actually has you paying less tax than an alternative tax calculation that the federal government has called the alternative minimum tax, then the tax bill that you'll owe is actually the greater of the alternative minimum tax on the transaction and your tax bill. So if the alternative minimum tax that the government requires you to calculate is greater than the actual tax you owe for the transaction, then you will owe even more tax than you should owe technically, because the government has these rules in place. And these are petty rules. Yes, these rules are meant to just kind of take a little bit more than maybe governments should. And it's unfortunate, but it's important to know these things so that you can properly plan for them, and then maybe even go into some more advanced tax planning in order to hopefully offset some of these things, but that's for another video. You also have to be aware of tax on foreign assets, and specifically when you have foreign assets called specified foreign property, if and only if the cost base, meaning what you purchased these securities for, is $100,000 or higher, you need to file a Form T1135. And that form discloses your foreign holdings. And most people don't know about this, but failing to file this form can actually result in a $2,500 fine. So this form discloses if you hold US stocks, ETFs. Another last minute thing that you need to be aware of is RESP contributions. Now you might be wondering, why would I have to care about RESP contributions prior to year end? And the truth is that if you miss a year of contributing to your child's RESP, it's not a big deal. But if you miss a bunch of years, it can make catching up next to impossible. In fact, the last year that you can actually catch up on grants is when your child turns 10 years old. The year that your child turns 10 years old, that is. And the reason being is because you're only allowed to catch up 2 years at a time. So if you were to put $5,000 in, you'd get $1,000 worth of grants. The reason why you don't want to miss multiple years as well is because there is the tax deferred compounding of the RESP. So you're losing out, especially if you're a high earner and have maxed out RSPs and TFSAs and are starting to invest in non-registered plans. Well, the RESP is the last tax deferred vehicle that you can compound wealth in, and it acts as an income splitting tool with your kids. So it's important to note that the last date that you can contribute to an RESP and have the contribution counted for the current age that they are at this year is December 31st. Don't miss it. The next one's pretty quick, but it's tax-free savings accounts. If you have a large purchase that you need to withdraw money from your TFSA in 2026, withdraw the money in 2025. That way, in 2026, your contribution room will reset. And if you want to recontribute that withdrawal, you can do so in the current year without having to wait until 2027. Lastly, and this is super important, many high income earners that have maxed out their RSPs and TFSAs are now implementing something called spousal loans. These spousal loans happen when you, the high income earner, have a spouse that's in a non-high income situation, meaning you're in a high tax bracket, they're not. You can loan money to them so that they can invest in non-registered investments and only pay a little bit of tax compared to the high tax you would pay if you invested in non-registered investments. Now, the way this works, and to stay compliant with CRA, you can't just give your spouse that money, you have to loan it to them. And then your spouse has to pay you a prescribed rate of interest, which is listed on the CRA's website. The absolute last day that you can receive that interest payment from your spouse is January 30th. If you do not receive that interest payment from your spouse by January 30th, the entire income generated from that non-registered portfolio will be taxable to you, the higher income earner. That means you're going to pay a heck of a whole lot more tax, and the whole strategy will be completely null and void, because the strategy is have the lower income earning spouse pay the taxes because they're taxed less. Now, you will notice I didn't mention RSPs here, and that is because you will have until March 2nd of 2026 to contribute for 2025. And I actually recommend not contributing to RSPs until you have all the income details of the current year understood. So that way you can say, I've got my T4, I've got all my bonus calculations, I've got all my stock option grant calculations, I know what I'm going to owe, and I know the impact of an RRSP contribution. It's what we do with clients every year. We go back through their current year, we calculate exactly their tax bill, we look at what impact an RSP contribution will have, and then we make it accordingly. Thanks for watching. My firm helps millennials make better financial decisions, and if you like this video, please like and subscribe, and reach out if you have any questions.